Well, welcome back in, everybody. It's been a minute, and I first and foremost want to wish everybody a happy holiday, happy new year. And in today's video, I just want to do a brief overview of exactly what I'm seeing. Now, I'm probably going to be hiring an editor pretty soon because I just don't have the time to keep posting videos. And ideally, I would still like to get one video out a week, but I believe this video is going to be important for a lot of people, because I'm going to talk through the deterioration that is taking place in this market right now. So let's get right into it. And as we close out 2024, 2025 themes are going to start hitting the table really soon. There's been a lot of complacency, a lot of risk taking. So with those themes in place, the Bitcoin theme and the AI theme, we've seen a lot of technology stocks really lead the way, and we're starting to watch breadth deteriorate. I'm going to go over that in 1 second. And we really have two stories taking place here. Now, if you've been following the channel, I do believe we're late cycle. A lot of indicators are pointing to late cycle. One of the most predictable indicators of late cycle behavior is going to be high inflation, Fed stepping in to control inflation. But once we get the yield curve normalizing, this is going to be the signal of end of cycle behavior. So now that the yield curve is normalizing, I truly believe we have a window here where we're looking at late cycle. Now, even if we take late cycle off the table, I want to point out that we are trading at extreme high valuations. We're in the upper decile. There's only been a few times in history where we've been trading at these types of valuations. When we look at the 1-year return in the market, we've really doubled our normal rate of return. And if we go over the last 2 years, it has definitely been a very, very strong bull market. And I believe we're pulling forward a lot of our gains. Now, a big reason of that has been government spending, but with treasuries flashing warning signs over the last couple of years, the market has just been pushing forward, regardless of what the bond market is doing. But what we're starting to see is that 10-year treasury. We've seen this huge reversal in the 10-year treasury that I thought would put more downward pressure on this market. Now, it is actually putting downward pressure on this market, but the top 5 to 10 names have really dominated the true headlines of what's taking place underneath this market. So with the 10-year treasury now pushing above 4.5%, this is where I have to pump the brakes and say, this is bad news for any companies that are carrying large debt, for any companies that are looking to get some sort of liquidity. And obviously your REITs are going to be in the headlines here. And I pointed this out numerous times doing analysis on companies like Realty Income. If we look at Realty Income's tenants, a lot of these tenants are underperforming, closing down stores. And not only are they going to have less tenants because those companies are underperforming, but they also have the headwinds of refinancing a lot of debt in 2025 and 2026. So if we see this 10-year treasury remaining elevated, this is going to be bad news for a lot of your REITs that have a lot of refinancing debt due. Now, this is going to be the real eye-opener here, because as the market is making newer highs, the thing I want to point out here is the moving averages are definitely deteriorating. What you have in front of you right now is the S&P 500 companies that are trading above their 200-day moving average. And so normally we've been trading between about 75 to about 80% of companies trading above their 200-day moving average. And what I want to show you guys is this. When we get down to right around 60, call it 61 to 62%, this line right here that I'm drawing, we've had a buy the dip crowd that comes in here and really takes advantage of these sell-offs. Until recently, we've broken down, which means that only half the companies are trading above their 200-day moving average, even though the market is making newer highs. To me, this is signaling an unhealthy market. We topple this with the 10-year treasury being elevated, and we also topple this with the valuations being elevated. The concentration in this market is extremely unhealthy in my personal opinion. And now that we're breaking down on the technicals here, as we can see, this is flashing a red signal. Now, to me, I've been saying, guys, we've been late cycle. It's been an extended late cycle. So a lot of people are probably frustrated or feeling like they're confused. But to me, the breakdown on the 200-day moving averages, the 10-year treasury, the Fed's remaining steadfast is signaling that muted returns could be coming here. We've had outlandish gains for the last 2 years, and I think we pulled a lot forward. So I tend to think that concentration in underperformers is probably where you want to be. So this is signaling a pretty substantial rollover on the overall health of this market. And the thing I want to point out is the speed at which this rollover took place. So I know I've given warning signals in the past, but this one tends to be something that's a little bit more eye-opening because we have multiple factors taking place here that is making it more and more likely that a pretty substantial correction could be coming. We're seeing multiple companies here obviously trading below the 50-day moving average, the 200-day moving average, which means that there is a technical breakdown taking place within the market as the market's making newer highs. Then we factor in a 10-year treasury that now is getting competitive to the valuation of the stock market. If we're looking at a 4.5% treasury versus a S&P 500 trading at a forward PE around 23 times, that 10-year treasury tends to be pretty competitive when we're looking at valuations this high. So that also tells me that we could be seeing a correction, and most times the bond market is the most sophisticated market, which means they tend to be the right market to be looking at. We're also starting to see some cracks here in the unemployment data. Now, if you've been following the channel, my biggest concern with the employment market is the fact that a majority of these jobs being created were government jobs, mainly due to stimulus, and service-based jobs, once again, which are mainly due to stimulus. We had a oversupply of capital in the market was flush with capital. And what did people do? They traveled, they went out, they spent money, and the government got bigger. This is not necessarily healthy for longer term trajectories of the market, but it does give you that sugar high of outsized returns when there's that much liquidity and a lot of M2 out on the market. M2 is actually growing and expanding, which is kind of contradicting what the Feds are trying to do, which means inflation could actually be higher, which could then lend the 10-year treasury remaining a little bit more elevated and maybe even pushing closer to 5%. As we head into 2025, I want to outlay some things here. I do have concerns with what's taking place with the technicals in this market. I have concerns with the 10-year treasury. I have concerns with the political tension and headlines we could be seeing. Now, long term, I'm very, very bullish on a change. I do believe this will lend an opportunity to some interesting underperformers that have been getting overlooked by the market that have some good fundamentals, and some of the names we'll get into possibly in the next video. As always, appreciate your time. Thank you so much for spending with me. Hopefully everybody has a happy holiday, and we will see you all in the next one.